What's up, you guys? Welcome to Young Money Investments. In today's video, we're going to be talking about stop saving, start spending in order to legally avoid paying taxes. Now, I know what you're thinking, Cameron, that's crazy. Spend more money in order to make more money? How does that even work? Today's video, we're going to be talking about the strategies that I have found to have been really beneficial and useful in order to lower my tax bill. Today's video, we're going to be talking about all those things and how I've been able to reinvest the capital that I've made to make me more money. All today in Young Money Investments. So to start everything off right, I want to start off by saying this is no way, shape, or form tax advice, legal advice, anything like that. This is all simply just things that I have seen and learned through my years and experiences in paying taxes. One thing I would highly recommend doing is finding a professional tax advisor or accountant, especially for those of you that are going into entrepreneurial businesses. Finding an accountant that will teach you and nurture you and kind of help you grow as a business owner and as an entrepreneur is crucial, because there are so many little laws and even loopholes in the laws that you will not know unless you have a seasoned tax professional. I found one that has been very helpful in helping me find those little small things, and so today that is what I'm going to be sharing with you. Alright guys, so the first thing we're going to be talking about is forming an LLC, S Corp, C Corp, or some sort of business identity. Now, I know what you're thinking, and if you do not currently have a business, you're probably thinking, how does this even apply to me? The reason this applies to anyone, whether they have a large business, small business, or even no business at all, is that the tax laws that have been written in order to help those that own businesses. The reason for that, simply put, is because those that own businesses are usually the ones that own homes that renters rent from. They're usually the ones that provide food. They provide shelter, homes obviously. They provide energy. Big corporations and companies are what provide us those necessities of life. And so the government obviously gives them tax incentives and breaks in order to do those things. Now, you might be thinking, well, aren't we trying to tax the rich more? Aren't we trying to get more money out of them? Yeah, we are. But the thing about that is that those laws are not able to actually hurt the rich or make the rich pay more taxes, because the rich are not paying taxes at all anyways. The rich take the money that they make from their businesses and they reinvest it into new businesses, showing that they really had very little to no gains. All of their equity, all of their assets are always tied up in other businesses. That's what you need to understand and learn as someone that doesn't own a business, is that is the way that they get away without paying taxes. Now, those of you that own it, that are in a job, that have a salary, that are getting paid on a bi-weekly, monthly, or even weekly basis, you are the ones that are getting taxed anywhere from 15 to 50% on your hard-earned money, and that's not great. We want to get it to where we don't have to pay any taxes, or as low as we can legally possible. The big way doing that is to form an LLC, or a limited liability corporation. Some of the big things, there are general partnership, sole proprietorship, and a limited partnership, and then you have the limited liability corporation, also known as an LLC. You have a C Corp and an S Corp. Biggest advantages to a sole proprietorship is that it is a default setup for a single owner business, which requires little to no paperwork. Owner has total control. Profits pass through the pass to personal tax return. Biggest difference is that, or disadvantage to this, is that there is going to be no separation between business and personal liability. Poor vehicle for raising money for investors. I don't recommend doing this one. This one I honestly and truly do not like, because it also opens you up to the possibility of getting sued. So if you get sued, you actually lose your the funds. Your personal assets and all those things can then be gone after by the person that is suing you. So I never recommend these ones. Biggest things that I've seen that I've used is I have used an LLC and I have used an S Corp. We're just going to talk about those for the sake of time. You can read through all these if you want. A limited liability corporation is going to be protection from personal liability, less record keeping than a corporation. Profits and responsibilities can be easily divided among the members of the LLC. Biggest disadvantage is it's not appropriate if you want to raise venture capital or investor money. Entire income of LLC members are subject to self-employment tax contributions, which you can avoid with an S Corp. Medicare and then Social Security are also rolled into that as well, so you pay more in those taxes. And S Corp, like I said, this is going to be a big one. It's protection from personal liability, profits passed through to the owner's personal tax returns. Only some companies are eligible, and more limits on issuing shares. If you are starting a small business, you are not worried about shares and that kind of stuff. So that is something that you do not have to worry about. But one of the biggest things in order to get this ball rolling and being able to spend money in order to save money is going to be starting up a corporation or some sort of limited liability, partnership, because that is going to protect you from being sued, and it's also going to protect you in the sense that you can then take all of your income from your business and reinvest it and basically show that you, the individual, did not make any money. Next, the second thing that we're going to be talking about in order to save yourself money is by putting money away into a Roth IRA account. In this table right here, you are going to see the differences between a Roth IRA and an IRA account. As you can see, in a Roth IRA, you can earn and put in anywhere from $6,500 to $7,600. Traditional IRA, you can earn $6,000 or put that in there. There is no taxes in a traditional IRA at the beginning, as opposed to there are paying taxes on a Roth IRA. I recommend doing that because your account is going to grow over time. As your IRA or your retirement fund or retirement account in the stock market grows, I assume that it's going to be worth a lot more in 20, 30, 40, 50 years when you end up retiring and putting that money or taking that money out. You don't want to pay taxes in the long run. But this is the nice thing with that IRA, with that Roth IRA, is that it grows tax-free. You pay the taxes up front as opposed to paying the taxes afterwards like you do with the traditional IRA. And that is what's nice, is because then you can actually start to withdraw $10,000, you can keep $10,000 and you pay zero taxes. If you do a traditional IRA, you are going to pay no taxes up front, but you will pay taxes on the back end on that money once you are retired. So the big benefit for that, as opposed to not even having an IRA account in general, is that you are going to be able to not pay double taxation on that. The problem with doing it in a normal brokerage account is that you are using capital that you are taxed on, and then any gains that you make right then and there are then taxed again. You're getting double taxed basically on your money. IRA and Roth IRA, super smart way to start protecting your assets from taxation and being able to spend money, put money into the stock market while still actually saving money. Now, this is going to be the third thing that we're going to be talking about, and that is using real estate to avoid taxation. Basically, there are 7 great tax benefits to investing in real estate. I'm going to talk about a few of them and go a little bit more in depth, but for the sake of time, if you want to keep this video shorter, just go to passiveincomemd.com and you can actually check out a little bit more of this information. So first thing we're going to be talking about is how capital gains home exclusion tax benefits. So as it says on here, if you've ever owned a home or used a property as your primary residential home for at least 2 out of the last 5 years before selling it, you're eligible for this exclusion. This exclusion, according to the IRS, states that if you have a capital gain from the sale of your main home, you may qualify to exclude up to $250,000 of that gain from your income, or up to $500,000 of that gain if you file a joint return with your spouse. Here's an example. Let's say you're married and bought a home for $500,000. You lived in it for 2 years and then rented it out for the last 3 and then decided to sell it, sold it for $1 million, leaving you with a $500,000 profit. Will you qualify under the exclusion to receive that profit completely tax-free? If you're a high income professional in a higher tax bracket, that can be significant savings, right? Depreciation. So another big deduction, this is going to be number 2, is depreciation, whereby the IRS allows you to deduct the cost of the business items that have a shelf life, like the building itself. Some might consider that the most powerful tax benefit of investing in real estate. Over time, the real estate which you've invested in is going to start breaking down. Fortunately, you're allowed to write off income producing property based on wear and tear. So basically in this example, you are able, and this is kind of the best thing about owning property, is you are able to write off the depreciation. Now, I'm not going to step into all of these specifics in depreciation of homes, how that all works. That is going to be left up to your tax professional. But I kid you not, guys, this is a massive deal when you are able to write off and depreciate your value, really lowering your total income that you are making on a rental property. So depreciation is huge. going through this is going to be very critical if you are looking to get into, you know, real estate investing. A 1031 exchange is another great thing to talk about. Basically, a 1031 exchange is named because of where it sits in the IRS tax code, section 1031. It states that it states that a taxpayer may defer recognition of capital gains and related federal income tax liability on the exchange of certain types of property, including real estate. What that means in simple terms is the capital gains tax are only paid upon the sale of a property without an exchange. Otherwise, these taxes are deferred. So if you take the capital gains that you made from property number one, and then within a certain time period, again, roll that money over into your next property, you are not paying any capital gains on that property. That is a huge one. We can talk about tax-free borrowing and refinancing homes. There are opportunity zones. There are so many different things with real estate investing that we could get deeper into. If you do want to talk about real estate investing, leave a comment down in that section and I can kind of jump into that. My mom is actually really good at real estate. She's one of the top agents in Washington right now. And we can talk a little bit more about that. But real estate, guys, I love stocks, but real estate has a lot of benefits in order to preserve and give you consistent returns. Now, if you don't have enough money for properties, that was the biggest problem for me, and that's why I got into the stock market. The way that you can actually start investing in real estate is by pooling your money with other individuals. There are opportunities out there. Again, if you have questions about that, leave them down in the comment section. I hope you found this video helpful. That is going to be some of the biggest keys that I can talk about in saving money by spending money on real estate, on stocks, and putting it into retirement accounts, in not paying taxes. That is going to really make you a lot of money, and doing it legally. That is the biggest thing, is doing it legally, because there are legal ways to do it. A lot of people don't understand that. They think that the rich are doing it illegally when they just don't understand that the tax code is written for businesses. It's written for corporations. It's written so that they can grow the economy, and that is what you need to do as an entrepreneur. Catch you guys in the next video of Young Money Investments. If you like this style, please give it a thumbs up. Please leave a comment down in the comment section and hit that subscribe button. I will catch you guys in the next video. Peace.